I think we are live and ready to go. Happy October 15th. The official tax extension deadline ends today. So if you haven't gotten a call from your accountant and you haven't filed since April 15th, you may want to get on the phone, but I'm sure most of you have. So we have an exciting webinar today. We're going to talk a little bit normal style. We're going to hit the market. We are going into an election, which we've had a lot of conversations and questions around, which is, less than a month away. And people are wondering how that's going to impact them, their investment decisions, and the market moving forward. We then have a very interesting conversation set up with DBD Partners and Iliya and Mike Fischer. Iliya Zogovic is the principal. Mike is on with us as well. And then, as usual, Q&A, we want to have that more dynamic throughout. So we have, if you have a question, put a question in the chat box. We will hit the time. But Sean, let's kick it off with the market update, baby.
Go on, kick yourself a market update. Sounds good. Well, we want to year to date. In the last 1 month, it's up about 4.1%. It continues to be the dominant index when you compare it to some of the other major indices that we look at. When we look at the NASDAQ 100, that's also up around 22%. You look at the blue chip heavy Dow Jones up about 14%. The small cap index Russell 2000 is up 11%. And the international index is up about 12.3%. What's interesting, if you look over just the last month, all of these indices have really enjoyed a healthy 1-month return. So 1-month performance for all these major indices before are between 4 and 5%. What many investors may be shocked about this year to date, the 10-year treasury rate's actually up about 6%. So even with the recent 50 basis point cut that we saw from the Federal Reserve, the 10-year treasury rate is actually up. You would expect it to be down with rates being cut. But the reason for this is a lot of this was priced in 2023. The market was expecting a ton of cuts in 2024. So when we see some of these economic data points like inflation coming in last month at 2.5 instead of the expected 2.4, that can shoot that 10-year treasury rate up a little bit. So it's been interesting to see how that interest rate moves over time, given that the Fed is cutting rates, but maybe not as fast as expected. So that's something that we're going to continue to monitor. Also, the strength of the US dollar is up over the last month. As I mentioned last month, that's a little bit correlated with interest rates. When foreign investors can get high interest rates in safe investments like US Treasuries, we see a little bit more influx of investments into the US, which boosts up that dollar. Brandon, what have we seen so far this month when we look at growth versus value?
Yeah, I think it's important to note, growth versus value, and then also how, the large cap companies are doing against some of the small cap companies. You can see in the 1-month performance, some of the mid cap and small cap companies have actually done better than if you look at the iShares S&P value and 500 growth. However, year to date, we still see that large outperformance on the growth side compared to value in each of the 3 categories. So something I think would be, interesting to see is one, how that follow through happens. If we come back again next month and we see kind of a bigger jump between small and mid cap, and then also, what is the Fed going to do with interest rates, and who are the biggest winners there? Will growth kind of continue, or will some of the rest of the market kind of catch up?
I think we got to spend another minute on the 10-year, because I think that's something that kind of throws some people for a loop. Interest rates went up to 5.25. The 10-year never got there. The 10-year never flattened out the curve. And when people think about interest rates, there are 2 things which are going to lead to what happens with interest rates: expectations around GDP growth, expectations around inflation. Those are your two inputs. So even though we're looking at last month, we had the Federal Reserve cut rates because they think inflation's coming down. At the same time, we had an escalation in the conflict in the Middle East between Iran and Israel, which we'll talk about in another slide. That increases the risk of inflation. So the fact that the 10-year Treasury rate was up is basically the market telling you they think prices in the future might be higher. They could also be saying growth might be higher. It's one of the two. But given the information and the data that we had coming in, probably leaning a little bit more on that inflation concern. And that's a concern that investors should be a little bit focused on. When you see the federal funds rate zig and the 10-year zag, something is happening here that markets are telling you that the future is going to look a little different than it did the day before. Might be because of what the Fed did, might be because of what other things are happening. And you kind of have to scroll back through that news cycle to say, which one had a difference? An 11.5% jump, that's not normal. That's not an average everyday jump. So that's probably part, a little bit better expectations around growth, but also probably expectations that longer term inflation might be here due to global conflict that we might see from oil producing countries.
Yeah, I think we had a big month full of news as we look at China talking about stimulus in their economy. We've been pretty high on India recently, but China coming out with some big news over the last month. They unveiled that new stimulus package to try to get their growth up to its 5% target number. China historically has been very cheap when you look at their multiples compared to some other countries. So this is some exciting news that got some fire underneath some of these China investments. As we look at FXI, which is a China ETF, it was trading in the mid-20s in September. And after this news came out about the stimulus, it had a big jump up to 36. And that's continued to show a lot of volatility since that time. But the stimulus package, they're taking steps to help local governments with debt. They're offering stimulus to people with low income. They're looking to give capital to state banks and also support the property market. So they're really putting together a holistic plan to try to juice up their economy that's been struggling recently. So that's something that we're going to continue to take a look at, especially in the market as we're seeing these huge changes in prices in some of these ETFs that track the Chinese market.
That's also potentially inflationary.
Yeah. I mean, we saw it with the US economy after COVID. A bunch of stimulus checks led to 9.1% inflation in 2022. So that there can definitely be a backfiring to a stimulus package. So we'll see how that plays out. Another thing that's been going on is just world banks, the Federal Reserve, how these world banks have been changing policy over the last month. As we saw in September, US cut rates by 50 basis points. The expectation for November 7th, as of right now, there's an 88% chance based on what the market is pricing in that there's going to be another 50 basis point cut. 12% chance that it's only a 25 basis point cut. So it'll be interesting to see if it ends up being that full 50 or if the Fed decides to back off a little. It's been a pretty similar story for most countries. Bank of England also cutting rates generally. The one caveat to that is Bank of Japan, which actually raised rates in July. And that's because they've been seeing a little bit of an inflation tick up. So that's kind of the outlier in this story is the Japanese bank. And then as Jordan was mentioning on the first slide, we've had this Middle East conflict really escalate over the last month. What are some of the potential concerns to look out for? What's been priced into the market? As we look at geopolitical tensions, there's some sectors that we think could really benefit from a market standpoint. You think about aerospace and defense, that continues to be a really good spot to invest in our opinion, that as geopolitical tensions continue to kind of be widespread. Cybersecurity, just between AI, hacking, I think cybersecurity is another sector that's kind of poised to do well in the future. And We're also going to see a lot of changes in oil prices because of this Israel-Iran conflict. With the Middle East being such a hub for oil and energy, we've seen a lot of volatility in the oil space with this conflict really sparking up in the last month. Is there anything else that you guys see in terms of the news that we've seen this month with the Middle East or China that you kind of want to speak on?
I think that Middle East thing is probably the freshest and newest, along with the Chinese news. We kind of try to filter through everything and find the things that we thought were most impactful when we're putting these slides together. So, if we put every headline on there, this page would look like a word salad. We try to just put the things that we think are really driving the messages. So, as we discussed, Sean and Brandon, before we put this together, this is where most of the meat is: save election. And that's a little bit of a foreshadow to the next slide. But it's really important that people recognize that things are changing pretty quickly, and it's probably going to continue to change at a fast pace because of the fact that we are in the midst of an election. It is likely that potentially countries use this as an opportunity. They know that America doesn't want to get involved in a Middle Eastern conflict right now. So if Iran or even if Israel wants to push the line a little further than they normally would, this is kind of the time to do it when there's flux between who's going to be in office and who isn't. And this is why markets tend to get antsy right before elections. They just don't like this uncertainty. They don't like this thing happening. It normally doesn't happen, and it normally doesn't escalate. This is this has in the past been posturing, and we hope it's posturing again, because the last thing we want to see is a drawn out war here. But this is really also a time when America needs to keep its eyes on the prize and not get distracted by the internal conflict and politics that we have going on here, because other countries are watching us, and they're trying to take advantage of moments when we're not so focused. And that's why I think as we get to into this election season, we kind of remember we're all Americans, and we've all got to focus on some of these outside threats that are sitting around the corner waiting for us to lose our focus on them.
This has probably been, and not just the Middle East, but just global political threats. I mean, this is always a big issue, and it's kind of like riding the wave, whether or not the heat is turned on high, or it's simmered down on low, and now it's probably mid range. But to Jordan's point, we got to pay attention. Always have to be paying attention.
All right, with the election now. So Bobby was actually quoted in an NJ Biz article recently, talking about the election, Trump or Harris, who would be better for business was the article title. So, one of the quotes that he had was, no matter who wins the presidential election, investors and their advisors should pay attention to broad trends and be ready to pivot. The Fed's interest rate decisions moving forward will be more significant than the election. During COVID, the markets dropped quickly, but then staged a robust, though slow recovery. The fundamentals remain, so look for strong companies and income-generating assets that exhibit some stability and value so that you can reinvest that income into equities during moving markets, which I think tells a lot and goes along with the points that we're talking about on the slide. So, really looking at what's in your control and taking emotion out of the equation. Things that, we're looking at and saying is staying financially disciplined. Remember your financial plan and the factors that are most crucial to it and that kind of goes back and forth with stress testing the potential scenarios too. So what are the biggest factors to you and your plan specifically? For some people, it could be, inflation and those expenses rising. Therefore, you're taking more off the top of your portfolio. Versus, other people, it could be an equity market drop or, potential tax policies and things like that. So it's important to know what has the biggest effect on your plan and, how to plan around that. What if one of those things do happen? What are the adjustments that you can make so you can stay on track to meet your long-term investment goals? And with that, building good investment habits. One of them that we say, all the time, being observant, not predictors. You don't necessarily have to be, saying, I was right, I called this movement, in the market, or X would happen. It's good to be observant and then make adjustments off of that. As Bobby quoted in the article, look at the broad trends in the market and be ready to pivot off that. And going back to, adjustments in your, investment plan, and then also in your financial plan. And then some things that are out of your control, potential policy announcements or things that both the candidates are saying. One of the, big things that we're seeing are what are the potential, tax ramifications in future years. And while this is all important to note and see what's going to happen, one thing to note about that is when is it going to happen? And also what is, the likelihood of some of these things being passed? Just because, that's a running point doesn't necessarily mean that, it's going to come to fruition. It could be, partially true, but it might not have the full extent of it.
I think the one thing that
Yeah.
people just need to take a little bit of a deep breath on is this is a time when the political candidates have the stage to set forth what their ideal agenda looks like. And they try to hit all the talking points that they think are going to move voters to the voting booth to click their name, and as opposed to who they're running against. So in the spirit of that, we can't take everything that they say for face value, because as we know, they have to get through Congress for any real changes. So yeah, there's going to be some tension. Yeah, there's going to be some really big talking points. Yeah, there might be some things that may or may not benefit you in your pocket or your belief system or whatever it may be. But at the end of the day, we've got to remember this is campaigning. This isn't actually running the country. Running the country, there's more mechanics to it than just the campaign.
Yeah, I think that's a great point to hammer home too. And then also, kind of going off that, what is driving the market? It's not necessarily, those announcements or, potential changes. It's really about, what are the corporate earnings? How are companies doing now? And then what are they saying or what are they seeing in the future for themselves? Inflation. And then also, interest rates. What is the Fed going to do throughout 2024 and through 2025 and so on? It's important to, kind of keep up with that, as that may, go back to financial planning and investments. How do those announcements or, rate cuts that they do, how do you make adjustments based off of those data points? Similarly, GDP and unemployment, just looking at the factors as they come out. And then you can plan along those, but not necessarily, trying to predict what's going to happen in the future. Gather all the data and have a full understanding, and then you can make an informed decision instead of, letting your emotions kind of go a little bit more off of, all the news articles that are in your face 24/7, really trying to take a step back and soak everything in.
I think another important thing just to mention there, Brandon, is not only are you laying out some great ways to approach this news heavy cycle where we feel like you're getting bombarded, but another thing to remember is most people are not going to have this discipline, and that includes professionals and individuals. So if you're wondering how to win, if you're wondering, what's the best way to come out of this environment and do it much more successfully than probably your neighbors, friends, and colleagues, it's to follow the advice on this page and stick with it. And a lot of people have a lot of trouble doing that because as things get closer or anything else, or, if you watch certain news outlets, the world is going to end right after this election, depending on which news outlet you watch and who wins. That's probably not going to be the case. And if you control and temper your emotions and look at downdrafts as opportunities and, random rallies in certain areas is also opportunities to take some off. If you think about it very level-headed, you really suddenly can get control of the game of what's normally kind of a crazy time. And so people shouldn't be worried about these times. They should actually get excited that now's a time where the men get, differentiated from the boys, or, women from the girls, or whatever other, term you want to use. So
I
now's a
think
good time to be focused and have your head in the game.
Yeah, I think we rely on gut intuition so often in our lives that when investing opportunities like this, or some of these news cycles come through and they get us a little bit anxious, and our gut intuition is to do something. More often than not, that survivor mechanism is good for most things in your life, but not for investing. So patience, diligence, good habits, discipline. This is when
Discipline.
those type. What was that?
Discipline.
Said.
So going back to the first slide, we talked a little bit about growth versus value, and that was more so on the shorter term. We showed 1 month and then also the year-to-date returns. So for this, it shows something similar with 3 months and then the 12-month returns. But we also wanted to break it out to a little longer term of 5 years, just to see how that's been playing out. So I think something interesting on the 3 months, you can see large growth has kind of been lagging behind. But then as you stretch that out to 12 months, you see that as, top of the leaderboard, say, where that's really been pulling a lot of weight. And even over 12 months, everything's done really well. But then as you kind of stretch it out to those 5-year returns, you start to see more of a difference. You can see some of the large, growth in core, which, core is kind of just a blend between the two, where there's no, material difference to outline that as either or.
So for people who are not like huge graph or numbers focused, what's the story that you're seeing here, Brando?
I think the biggest thing is, over longer periods of time, you're starting to see those large companies do better, and especially as you start to lean more towards that growth from value. And I think, some of that is with, those large companies. If you just look at Apple or Microsoft, for example, they're a lot more mature companies where you kind of know what they're doing. There's a lot more information out there about them. And not that they're predictable, but kind of like I said, they're a lot more established versus some of the small companies. And we'll just use growth as an example. They might be a lot more innovative, but they don't necessarily have the history behind them, and they might be a lot more volatile in the short term of it. But it's something to look out for of over the short term, what's doing the best, and then over long term, how can I be a little more tactical, during certain environments versus, what is the best long-term investments? Yeah.
Cool.
How about also the last 5 years have been a great time to be invested? Look at those numbers.
That's
Really?
true.
All right, guys. So listen, I want to welcome Mike and Iliya. Mike was actually just on a podcast. Iliya was on our podcast a few weeks ago. These are two guys that are super sharp, and in a world where there's a lot of movements and transitioning assets and businesses, these guys really do a great job as investment bankers on the M&A side to help to put together deals. I've known Mike for almost 15 years. Iliya just a few, but in the short time that I've known him, I could tell how sharp he is and how good he is at his trade. And these two guys really do a good job when they come in and speak to you about your business, your potential opportunities, and how to either take it the next step further, or how to find your exit in the most thoughtful and meaningful way, well and beyond just the dollar amount, but just your intention of what you want to see your business continue from a legacy standpoint, even after you're gone. So, Iliya, Mike, thank you for coming on board. I'd love to make this an open conversation. So, love for you guys to just kind of jump in and talk a little bit about your firm, what you see in the markets, and and how you provide value to different clients.
Yeah, for sure. Happy to jump in first, and then Michael, if you want to compliment if I miss anything afterwards, feel free to jump in. I'll start with what we're seeing in the markets, right? And because I think it's a good segue from where we're coming right now. This year has been probably one of the best years in M&A since the end of the pandemic. And we had those 2 years, 21 and 22, that were completely out of the charts. And if you see the M&A volume and multiples, et cetera, 21 and 22 are complete outliers. And it's really hard to surpass that, right? Money was cheap, to not say it was pretty much free. People were in home trying to figure out what to do with their lives, and a lot of transactions were going on, and there was a lot of appetite. I mean, I remember people closing deals in 30 days after signing an LOI, right? No due diligence, no nothing, just let's go to close, which is mind-blowing, right? Like you don't see that.
Free money, baby. Come on, free money.
Absolutely, absolutely. Now, the interesting thing is a bunch of those companies that were bought, closing 30 days after LOI, right now are in trouble and are being sold for maybe what they came in at, or maybe even a discount. Because if you don't do your diligence, you end up in the wrong side of the table, right? And that's to Bobby's point earlier. When you're doing investments, especially in a market like this, that it's changing, that has so many different moving parts and so many things that can go wrong, you need to do your homework more than ever. And I think that's what we're seeing now, coming back to that trend. 23 was pretty slow. I think there was a lot of hesitation and nerves in the market, or people were nervous about what was going on. The interest rates were high. Nobody knew what was going to happen. But at the end of the year, people realized, and I mean end of the year and end of 2023, realized, hey, we raised money. We're sitting in, for the last estimation, I think it's like $1.6 trillion of money on the sidelines on private equity, private credits, et cetera. And we promise our investors and our LPs returns. And the only way we're going to do that is putting this money to work. And this is our new reality. Money is not going to go back to be free, at least not immediately. I'm not going to predict what's going to happen 2 or 3, not even 2 or 3 months down the road, because everything is off the grabs. But I don't think money is going to be back cheap or back to zero anytime soon. And investors, buyers, lenders got back to the idea, okay, this is our new reality. Let's go make deals. And we kind of set back to the post-pandemic way of doing deals, right? Deals now are taking 60, 90 days to close, as they should. And the people are taking way more seriously their pre-diligence time. They're not being as trigger happy, et cetera. But the volume is continuing to accelerate. And if we normalize for the 2 outstanding years of COVID, we're actually on track 2023 to be the best year against anything before the pandemic, right? So that's what I'm seeing in the market, Bobby. Just real, high level. People are out buying companies, and I also think that people are out trying to exit their businesses or thinking about exiting their businesses, because they don't want to wait for an indefinite period of time to see if interest rates go down, and that means multiples go up. And
So
that's
I'm assuming that was definitely the dynamic when the interest rates first started rising. People were going, "Oh, wait, I can't get this amount of money anymore for my business because money's more expensive for the acquirer to borrow." Obviously, we've gone through a period of time now where that's become like the new normal. What has been the general sentiment? I mean, I'm sure most buyers aren't coming to you and saying, "Hey, listen, I'm looking to sell tomorrow." It's probably a longer term plan for it, but give us an idea of what that environment's look like for you.
Yeah, and I think it's twofold, right? On the one hand, you have the business owners that didn't exit their business during the pandemic, and during that, let's call it the 21, 22 boom, just because it wasn't the right time, et cetera, for them. And they probably missed an opportunity to sell their company for a irrational multiple, right? But it's the same thing that happened to people that had houses and sold them during those periods, or you didn't, or the same thing that happened to people that bought cryptocurrency and crap like that. And they won a lottery ticket, and you need to kind of like let that ship sink and realize, well, this is the new reality, which is still pretty good. I mean, the multiples that we're seeing in the markets are pretty stable. I think last year was still the average middle market deal closed at around 11 times EBITDA. That's a very good multiple. And
So what have
Yeah.
been some of the emotional struggles that you've seen? Like what are the emotional headwinds that you guys have been hearing that you have had to overcome through conversation and collaboration to get people to maybe look at this new environment in a way where they can say, yeah, you know what? We should figure out how to move forward.
I wish I had a better answer for you, but I'm not in the business of convincing people to sell their businesses. I'm in the business of helping people sell their companies. And I say that like with utmost respect, but it's a very hard process, both technically and emotionally. And if the person is not completely on board and convinced that it's the right time to sell their business, it's going to break down, because it's going to break down during the diligence process. It's going to break down when they realize that they need to let go of their legacy, and at some point their work families, that they end up spending more time with them than sometimes their actual families. So I'm not in the business of convincing people to sell their business. Now, that being said, I've had a lot of conversations over the past, I'm going to say 18 months, when people are like, I don't know if it's the right time. Like, are we going to go back to the multiples that we had? And that's when the conversation turns into like, well, the reality is the multiples are not that far off, right? You are maybe getting one turn less of EBITDA. They're valuing your company at one turn less of EBITDA, but your EBITDA is probably higher than it was 2 years ago. So net, you're probably getting the same, if not maybe a little bit more than what you were getting, or what you would have gotten 2 years ago. And there's ways of bridging those gaps, right? Why are the multiples lower? I say that on quotations because I don't think they're that much lower. It's because in a lot of respects, cost of capital is a little bit more expensive than it was 2 years
So
ago.
have you found yourselves like really being creative and putting deals together to make sure that the buyer and seller are,
Absolutely. And that's where like structure comes into play, right? Structuring the deal correctly with the buyer and working with the buyer to bridge that gap, right? The most common tool that we can use for bridge that kind of situation is using seller notes, where basically the seller is financing part of the transaction, and it's financing that gap that the current lenders can either not get to that additional turn or two of leverage, and the cost of capital now is that much more expensive that you don't want to put it on a traditional or private debt, etc. But if the seller can come in and finance that at, let's say, 600 basis points or SOFR plus 200 basis points, which is still more than what you would get in a normal investment account or money market account, and you're willing to finance it for the next 2-3 years, that's a way of solving that gap between the current valuation and what was going on 2 years ago.
I think to your, Bobby, you were saying, like, I mean, we're definitely not in the business of convincing people to sell their business, but we are in the education business, right? And what we're trying to do is you need to have that long-term, that explanation of that this is a long-term process, right? So what I like to do when I just, talk about, things with business owners is, hey, what is the next 10 years, plan for you guys? Where do you see the company going? And then you can kind of work towards the exit. And people, they don't know what they don't know, right? And this is a very, complex and thorough process that you need to go through, and people need to have a clear understanding of it. And they're probably a little cloudy from what they saw in, 21 and 22 from that post-pandemic boom where everything was easy and you could sell your business for all these, crazy multiples. And, like Iliya said, very little due diligence process. Times have changed and we need to educate people on that.
Yeah. And on that note, I think, and Michael spends more time out there talking with potential clients and talking with people. He's way better at that than I am. But I think
don't sell yourself short. Come on.
one key thing that he just mentioned is it's a long process, right? A transaction is going to take 8, 10, 12 months from start to finish. Average is 8 to 10 months from the minute you say, okay, let's go and let's sell the business to the minute the money changes hands and everybody goes for a closing dinner. But the work starts before that, right? I would say maybe 2 years before you even think about that, they need to sit down with somebody like you and figure out, okay, how much money do I really need out of this transaction to accomplish my goals, right? Because yeah, maybe you're getting 10% less or 15% less than what you could have gotten 2 years ago. But it's going to take you 3 years to continue to grow the business to get it back to that stage. And over those 3 years, a lot of things can happen, right? Like we were just talking about markets and all of the kinds of risks, and you have geopolitical risks and economic risks and internally political risks and et cetera, that can trigger a huge change in your business, and you end up with less than what you have right now. So all of those are the things that business owners need to consider when they're selling their business. And it's a lot of moving parts. Like Michael, the team here, we do the fun part of it, right? Like we get tapped in when people are ready. And I always love to see it that like we're like special operations, right? We're ready, we have a plan, we execute, we get out. That's it. It's like, and if we do our job correctly, everybody gets out alive and with a lot of money. And we usually,
I think, we see a lot, from our perspective, when we see people coming through the door and even just talking about their long-term horizon, it's usually fear or excuses are in the way, right? To your point, it's the fear of, do I have enough money? Am I going to get enough money? After taxes, what's going to be my, what's going to be my nest egg that I can build off of? For serial entrepreneurs, it's a little bit less of a concern because they're probably just going to fold in and roll into the next endeavor. But for most people, they're not serial entrepreneurs, right? They've been doing it for a long time. And the excuses then become, well, I'm going to get hit really hard with taxes, or, I'm probably not going to be able to sell it for as much as, or I want so much more money than what people are really going to be because my back of the napkin math is what my buddies and I have been talking about, being the industry standard. And really, what it comes down to is those excuses from our perspective is really the work of, I've identified myself as being my business and we're one at this point. How do I look at the rest of my life without that business? How do I detach from that, my identity? Because it's been my baby. I've nurtured it. I've built it. I've expanded it. It's been taken up hours of my life with my family. And this has been what I've created. Now I have to think about who I am outside of my business. I don't really know if I can identify with that. Yeah. Do you guys have that emotional conversation I know you said you're strategic, you're in, you're out, you're like special ops, in and out. But how often do you get caught on, on clients being a little bit hung up on the mechanics of actually releasing that to be sold?
You see it. So that happens post LOI, right? Like the process is very simple. Like the first part of the process, we create all of the documents and all of the, we organize a company, et cetera, et cetera. And then we go and we present it to potential buyers, investors, depending on what you're trying to do. First by ourselves, and then with the help of the company and the management team. And then eventually we get offers, right? The famous LOIs, letters of intent. all of that process, it's usually very exciting. People are on board. They thought about this. They already sat down and figured out, okay, I'm going to get 50 million, whatever the number is, 10 million, whatever your number is. And they figure out, okay, I can live with that, or whatever. LOI gets signed, and there's two things that happen. One is that's when the buyer really starts knocking down every single tree to see what's behind it. Right? They go into a full diligence and start uncovering everything in your business. And it's a hard time for the business owner because they start questioning him about everything that's going on in their company. Why do they do this? Why do they do that, etc.? So it's a very uncomfortable situation. So somebody the other day told me that it's like having a root canal while you're doing a colonoscopy. That's what due diligence.
Wow, that's terrible.
that's a feeling you get. So it's not pleasant. And that's when those questions start to surface, because one is, why are they questioning me about my business? And then it's like, what's going to be my life after I sell my business? What is going to be my identity at the golf course when people ask me how things are going, et cetera, et cetera. And I think another psychological factor that I had conversations around is, for 20 years, you've been special because you've been able to take this business from zero to wherever you go, right? It's your hero story. And now somebody else is going to come in, step in, and do it better than you. And every day for the past 20 years, you told yourself that you were special and you were unique. And nobody wants that. It's hard, and they start being, the buyers start coming in with their consultants and start sitting down with your management team and being like, this is what we're going to do day 1, day 2, day 3. And they're not your ideas. And some of them you think they're good, but they didn't come from you. So you can't really buy into them, etc. That's where we stop being the precision action team. And we need to sit down and have those more humane or heart-to-heart conversations. And
so this is not the first time we've had conversations about, exit planning, exit strategy, selling your business, whether it be from the legal aspect, or now we're talking about it from the investment banking standpoint. We've talked about it from a financial planning perspective. Sure. I think at the heart of it, though, is the reason why we keep bringing it up is because it is very nuanced. It is a long process. And the people who are just starting to think about it when they want to sell their business are usually the ones that don't have such a successful transaction as those who are preparing in lead up to the transaction years in advance. And how often do we see where things are measured in ways that the business owner is not anticipating being measured, and they're not able to correct things in their business to be able to account for how their company is going to be valued more. So whether that's, hey, I'm taking these write-offs that maybe really aren't business activities, it might be more gray area, and it's dropping your EBITDA, versus, you know what, let me just pay for it after tax and just show exactly what the company's doing. And those will be stripped down versions. What are some of the things that you see that business owners should start keeping top of mind, even if they're like, I'm 3 to 5 years out? Because I think that's what 5 years. 5 years seems to be the magic number that people like to kick the can. What do you tell to somebody who says, I'm 5 years out?
Yeah, I mean, and that's a great point. The write-offs, et cetera, it's a common thread. Although, and I agree, like if you should be paying after taxes and get rid of that issue. But that's the easiest thing to solve, because that's where adjusted EBITDA comes into play, and you add.
I was picking something easy. That's I was gonna I'm picking you with the rest of the list. Come on.
But I would say employees, like really building a bench, a talent bench behind you, because I'm not going to say nobody wants to come in and buy a company that depends on one person or depends on one person, But if you have a company that is correctly staffed with a talent bench that goes deep and goes wide, that creates value immediately, because somebody's going to see the company and be like, okay, if Iliya gets hit by a car tomorrow, the company still operates. Not only that, the company has a team ready to grow. We can go acquire somebody else. We can easily integrate it into the business. We can develop a new business unit. We can inject cash into the company and know that this. So start to think about the team and start giving them the opportunity to really make decisions, make mistakes, correct their mistakes, et cetera, et cetera, et cetera. So I think human resources is a big part.
And from a value in, value out, when you talk about your deep bench, how important are having the right employment contracts in place? What are some of the key elements in that makes a difference for business owners to think about?
I was gonna say that's the second point, is contracts in general.
Sorry.
Not only, no, it's perfect. Like you cued it perfectly. Not only employment contracts, but all of your contracts. Get all of your contracts in order. Like, yes, of course, the right employment contracts that have clear clauses, especially for those key employees that have retention bonuses, right? Like in case of a transaction, if you stay for 2 years, you're gonna get this much. But have those things already in place, because we've seen transactions fall or try to fall out of place at the end, because somebody in the employee, somebody in the headcount gets smart and figures out, wait, the buyers need me to move forward, and the 2 or 3 weeks before the closing, they try to renegotiate their entire employment agreement, and of course that creates a revolution, and the buyer wants to deduct it, etc. So get your employment agreements in place. If you're unionized, et cetera, which, you know, companies that are unionized get sold and bought and sold every single day. Make sure you have a strong relationship with the union. Make sure you have strong contracts with the union. Start speaking with the union about a potential transaction when that's still not on the like when you don't have it on the table. You'll have way more bargaining power before the transaction, when it's only an idea. Everybody's amendable and everybody's friendly, etc. When it's just an idea, that when your union leader actually figures out, wait, you're about to cash out $100 million and you're trying to shortchange me and my group. No way. Like, and that's when you start to make all of those all of the contracts with your clients very important. We've sold companies that have 20, 50 years of relationships with a client. And sure, they've known this client for the past 20 years. They've been doing business for 20 years with a client. And the last time that they renewed the contract was 6 years ago, because they don't care. They play golf every week or every month with the owner of the other company. They're best friends. Sure, but they're not best friends with the buyer. And the buyer has an investment committee, and he can't say, oh, our main client, there's no contract, because it's you know, a gentleman's agreement. And again, it might not be the best moment to go and try to renegotiate that contract, because your best friend might also be like, well, sure, but you had those terms because it was you. I was giving that to Bobby. I'm not going to give the same terms to Michael. Like, these guys are sharks from Wall Street, and they're going to get the same price. So
you also don't want to do that in the 11th hour, because not only is that a tremendous lift, right? I mean, just the thought of it, if you haven't been doing it, it's probably super daunting. Absolutely. But also you don't want to have that conversation with most people where you're saying, hey, listen, I'm going to be gearing up to sell the company. I need you to sign the documents. You want to be able to confidently say, hey, listen, I'm just trying to get my ducks in a row. We haven't done this in 6 years, to your point. You know, I'd love to just maybe meet once a year. We'll do it again next year at the, you know, when this is canceled. But I was talking to my professionals and just having my books in order. I feel like the right business relationship is, let's do this on an annual basis. Or, you know what, we haven't solidified what your employment agreement looks like. We should probably be doing this every other year. Let's talk, you know, this year and firm it up again in 2 years. So that this way you're talking about the future, and the continuing relationship as opposed to being like, I'm out in 12 months. So please sign this. Please make sure all the files are complete for HR. Please make sure we have all of our agreements in place.
Bobby, I think it
And
all
that-
like back to your point. I'm sorry, Ilya, go ahead.
No, sorry.
What I was going to say is, I've spent, the majority of my career in commercial finance, right? So as a banker, you'd go in and you'd see like someone's like AR reports, right? And there's a huge amount of customer concentration, right? So your banker says like, hey, you're only doing business with ABC company all the time, and they keep telling you this every year that you should worry about it. Listen, right? When your accountant says, hey, you're putting way too much of your personal expenses through the business that you're going to get caught up by the IRS. Listen, right? When you have, your employment attorney that's coming in to, look over your handbooks and everything like that and says, hey, you should really probably sharpen this up. Listen, because these are all the things that are going to come out at the end. And what I always say is, when I would write up proposals for deals to get approved by credit committees and whatnot, the first thing I would talk about are the problems or the issues and how to mitigate them, right? So I'd rather go in and be very transparent about that to a potential buyer than, at the end say, oh, you got me there. I forgot about this or I forgot about that. I'd rather address it in the beginning and then mitigate it. And I think that that's powerful. And that's something that you can do over the time before you go to actually sell the business.
Well,
And then this
much
way
as
you won't
you
have any
may-
issues.
And as much as you may think or feel like that's really expensive, oh, I gotta do this, I have to do that. The cost is minimal in the grand scheme of things when you look at the impact that it could potentially create. Or if you've got to go back and now jam everything in a short period of time, and now your professionals are under the gun, it's gonna be a much bigger bill than if you spread it out over time. So, I mean, listen, like that.
And then the other thing I was
I'm
going to say
stealing
too
that.
is like,
Listen.
yeah, you and I both.
I might use that
saying-
for my kids too. Hey, listen.
We're working on it right now, obviously, with the Green Ridge team, right? It comes down to assembling your allies, right? I mean, if you have a great financial advisor, like Green Ridge and Bobby, you have a great accountant. I see Stu Brown is on the participants here. Great, great law firm, great transactional attorneys, right? Like these are people that you're going to talk to regularly anyway. And you tell them like, hey, I'm thinking about exiting in the next 3 to 5 years. Is there any things that you can help me kind of see around the corner to see what could come up in this that you might want to help me address now? And they're going to be happy to proactively go after it instead of trying to do it at the 11th hour, to your point.
Yeah. And to your point earlier, Michael, around listening, et cetera, is if you have client concentration, which we all know is a risk, and we all know it's a discount, et cetera, do something to change that. Look, you're not going to change your customer base in 2 years. And if one client represents 30, 40% of your revenue, odds are it's still going to represent 20 or 30% of your revenue. But if you're able to lower that by 10% and you can show how you did it, hey, we went out and we brought these 3 new clients in the last 24 months, and we think that they already grew from being 1% of our revenue to being 10% of our revenue, and we know in the next 3 years we can get them to be 40% of our revenue, and now our customer concentration disappeared. You made an argument, and it's something that an investor will buy in. They'll understand what you're saying. And one last thing I
You
would
have
say,
to know that that's an issue before you mitigate it, and you
of
have
course,
to talk.
that's why you have to listen.
in direction. That's why you gotta listen, right? But I think most people, they get so caught up with the day-to-day, month-to-month, year, quarter-to-quarter, year-to-year. By the time they're ready to go, they go, "Oh my God, I didn't even realize that this was going to be an issue. Why? I thought it was all on revenue. I thought it was all on EBITDA. I thought it was all on a multiple." And you're like, "Nah, it's a little bit more nuanced. Just a little bit."
And then document everything in your company, right? Somebody that wants to buy a company needs to understand what the hell are they buying. So document, spend 2 years, 3 years documenting everything. And when I say everything, I mean processes. How do you open the door of the factory in the morning? Is there a specific temperature that the thermostat needs to be? At what time does it close? How many lights do you have on? It's like, how many pieces of paper does it take to come up with a quote? It's everything documented, and of course, try to streamline it and make it better. and then just put everything in paper, say, because that will make the buyer way more comfortable on what they're buying, and it's going to make the whole diligence process faster and more pleasurable.
And the
And
buyer's
selfishly,
job
it
is
makes.
help.
Yeah,
I was going to say, and selfishly, it makes our jobs as your investment banking team a lot easier when you have all these processes documented, so that we can steal like artists and put it into our presentation. And
so much easier.
Yeah, but I mean, buyer's job is to poke holes in your business, right?
Absolutely.
LOI, you accept the LOI, we're going through due diligence, and now it's time. Hey, listen, I'm going to pull out the biggest punch and I'm going to start poking holes through this thing, because I need to find out what kind of risk I'm up against. And if I can't get comfortable with the risk, I might not pay as much, because I might want to take some money off the table just in case. A lot of those things are what fills those gaps. They fill those holes in, and it makes it a little bit harder, you know, to punch through ballistic nylon than it does through tin foil.
Absolutely.
And I would also,
we're on the other side buying companies for our clients. That's the same thing we do, right? Like, once we have the LOI in place, our job changes, and it's like, let's make sure that we're not buying our client a problem. Because at the end of the day, they hired us to find them a good asset and make sure that they can make a return on that asset. So let's poke every single hole into the nylon until we're sure that this thing is what they showed us.
and I think that the other thing too is, right, we've seen a lot of companies, come to us that have had a bad experience themselves trying to sell the company on their own, because they don't know what they don't know. They only see the really shiny, great, perfect things about their business. And then they're never willing to put that light on the stuff that could be a challenge, right? And that's one of the reasons why you hire an investment bank, like DBD, to come in to be able to help kind of guide you through the process. Because, when a potential buyer comes in and says, hey, well, what about this? And you don't have a good answer for it, or the mitigant, that's where things are going to go south quickly. And then they come in at the 12th hour and ask us to come in and help them through the process.
Yeah, I think most people they can't quantify that in their heads. They just go, investment banker, expensive. How can I avoid that? And cost is really only an issue in the absence of value, is what I always am saying. And that's why a conversation, or having a conversation and seeing what your options are and seeing where the common pitfalls lie, is important. Because as you start to go, you know what? Maybe I don't want to deal with this. Maybe I don't. Maybe it is a little bit more. Maybe I could get caught up in a few things that I might not be ready for. Maybe I want to spend more time actually running my business, so that this way, if something happens in this transaction, I'm not falling behind the 8 ball. Let me let some professionals come in. There's different reasons why you might want to use certain professionals, and there's some reason why you might not. But if you're not informed and you're just making these decisions because you're like, investment banker sounds expensive, that's really not the prudent man's path.
Yeah. An attorney once in a conference was having a conversation around this and used a great example. Unfortunately, I can't use it myself, but you guys can. Which is like, you don't pay somebody to cut, like, you don't cut your own hair, right? You go and pay somebody else, but I do it. Like, unfortunately,
what do you use in that I can use it, you can't use, but
but if something's so low risk, you actually outsource. Why wouldn't you outsource what is probably the most important transaction in most business people's life, right? The serial entrepreneur, et cetera, it's a different story. But most people sell one company in their life. Outsource it to somebody that's an expert and does this day in, day out, day in, day out.
So we're coming in at the top of the hour. And I want to make sure that you guys can just whatever parting remarks that we might have missed that you want to make sure that you hit upon, and then maybe real quickly where our listeners and viewers can find you. And we're going to have all this information in the show notes as well as out when we send this to our existing network. We'll have the context on how to reach you and how to get in touch. But a little verbal and maybe some things that we might have missed that you guys want to make sure we capture before the
I mean, I think we covered pretty much everything that we wanted to cover. I always like to wrap everything up saying, great companies are bought, they're not sold. So build a great company, build a company that's going to last the test of time and that you would be happy to run for the rest of your life. And that's going to be a company that somebody's going to want to buy if you want to exit the business. And, it's a complex process. Listen, and to steal from you also discipline. It takes a lot of discipline to get to where you need to be.
Yeah, I like the concept of like assemble a team, right?
Yeah.
You don't want to assemble this team when the enemy is on the front lines ready to attack. You want to have the team assembled so you're in control of the process. And I like that thought process of like, I think you said assemble your allies or...
And I think
assemble your
it's
allies.
Four key elements, right? You need attorneys, transaction attorneys, like your corporate attorney that put together your employment agreements, et cetera, can be a valuable advisor through the process, but you need somebody that has M&A experience, that have like a transaction attorney. You need accountants to get your books to work there and make sure that they're going to be able to pass a quality of earnings and other types of diligence, et cetera. Some accountants are able to do it, your current accountants, some are not. You need wealth advisors. You need somebody to come in and give you a really good perspective of what your future looks like.
Jordan and I know a great company we can refer if you guys need it.
It's super important because you need to know what, after everything, after the dust settles, et cetera, what do you do with the money in your bank account to make sure that it's gonna last for whatever you might want to donate it all. That's fine. Just make sure that most of it gets good use. And for that, you need a good advisor, right? Why give a charity $10 million if you can give a charity a trust with $10 million that's producing 6, 7, 8% return year over year for the next 100 years? Like, sit down with a good advisor. And then, of course, investment bankers, because you need somebody to come in, do the dirty work, and get out with everybody alive and a lot of fun.
I think we touched on this on the podcast earlier today, Bobby, but we have and when I joined DBD, we have that give first mentality. So we give a lot of free advice, and in the hopes that people will come back to us and let us be their trusted advisor. So I would say if anybody wants to get in touch with us, they can certainly reach out to Michael at dbdpartners.com. We're happy to have early conversations with you. Hey, we're thinking about selling our business. What's an approximate valuation you could see for us, getting our company? We're happy to have those initial conversations just to give people a high level overview of the process, because it is quite complicated, but we're happy to make it easier and more comfortable for them. So.
Correct.
Yeah, I think most people don't appreciate the fact that how their business is really valued and the things that they can do now to increase substantially the value of their business. While they may be keeping their eye on the ball straight ahead, there may be something coming out of left field or right field that they really should be paying attention to, because that is going to really bring them to the number that they need versus versus what they're focusing on today. So I love that, and I hope people take you up on it and take advantage of that. And obviously, always you can reach out to us if you have any questions, or if you want to reach out to these guys, or you want a specific introduction. We'll be more than happy to make it. Jordan, do you have any parting remarks?
You guys are good.
They don't call the best color man in the league for nothing, folks. Sorry, I had to give my Bob Uecker before we signed off. But all right, November's coming up next. We're going to be post-election in our next one. If you guys have any questions around the election, we might be having a special webinar just around investing, in this kind of political environment. Stay tuned for that. And until next time.
Sounds good. Thank you.